Every move before this reduces taxes. This one changes the ceiling. As long as all of your income comes from work, your tax control eventually caps out. You can optimize, you can shift, you can time, but there's a limit. Real estate is where tax rules stop behaving the same way and starts rewarding ownership instead of effort. Everything you've seen so far reduces exposure on income you already earn. Real estate does something different. It creates paper loss that can offset real income while cash flow stays intact. That's why the move only works after the earlier ones are in place. In this video, I will show you why real estate plays by a different set of rules inside the tax code. Not because it's trendy, not because it's risky, but because depreciation allows deductions without giving up cash. This is the move where tax planning stops becoming defensive and becomes structural. Up to now, you've seen how to structure income, shift brackets, convert personal costs into business expenses, move money tax-free, deduct travel, use vehicles correctly. Those moves reduce taxes. This one creates leverage. Real estate works for one reason: depreciation. It lets you claim non-cash deductions while preserving cash flow. That's not a loophole. That's how the system is designed. This is where people get confused. Traditional rentals, they're treated as passive. Losses, usually trapped. Very limited ability to offset W-2 or business income. Short-term rentals, when structured correctly, can be treated as an active business, allowing losses to offset other income, unlocking accelerated depreciation. Same asset, different classification, very different outcomes. To unlock this, three things must be true. Average stay requirements are met. Material participation is documented. Records supports the activity. Miss one and the losses revert back to passive. This is not automatic. It's intentional. Cost segregation front loads depreciation. Instead of spreading deductions over 27.5 years, a large portion is accelerated into earlier years. Example, $750,000 property, $225,000 accelerated depreciation, non-cash deduction. At 35% combined tax rate, that's roughly $78,000 in tax reduction. Same property, same cash flow, different timing. This is where people usually say it's rigged. It's not. This is how tax code is written to reward ownership, risk, capital deployment, long-term housing supply. If you don't own, you don't receive the incentives. Here's how people blow this: buying without planning, missing participation tests, skipping documentation, assuming appreciation is the goal. Appreciation is a bonus. Tax control is the feature. Now the full board is visible. Income structure feeds deductions. Deduction supports cash flow. Cash flow supports ownership. Ownerships unlock depreciation. This is why two people earning the same income live in completely different financial realities. Real estate isn't powerful because it's popular. It's powerful because it creates paper loss. It preserves real cash, compounds year after year. This is where tax planning stops being reactive and becomes strategic. So this is the final move out of the 7 tax move. These aren't hacks, not loopholes, not internet nonsense, just the order the tax code already rewards. You play the sequence. You don't just lower your taxes, but you control them going forward.